Hello and welcome to Options in Plain English. Today we're going to do an introduction to the concept of volatility. We're going to take a look at what it is, and we are going to see how it influences the pricing of options. Even though we're not going to talk about any formula, we're just going to talk about the concept of volatility so that you can have a good understanding of why this is such an important concept to understand when we trade options. So, what is volatility? Volatility means change, how often something changes, and how big those changes are. If we want to think about it from a conceptual perspective, we can think of something being volatile as it being the opposite of something being stable. So, something that displays stability is going to have very little volatility and vice versa. So if we want to apply it to our stock market, what could we apply it to? Well, it is applied to the pricing of a certain underlying. So how often those prices in the market change over time, how big those changes are, and whether the stock itself or the any underlying that you're analyzing is stable or volatile. So for example, here we have a price chart of Boeing and Johnson & Johnson. I've superimposed both charts using the same scale of pricing and time. So the x-axis is the time and the y-axis is the price of the stock. So we can see how the price of Johnson & Johnson has been changing over time. This is here down here in the white color, and how Boeing has been changing over time here in the teal color. So right away, remember, these are the same scales, both for time and for price. So we can see that Boeing has been changing much more even before this big drop. It changes much more than Johnson & Johnson. Johnson & Johnson is remarkably stable. Now, if you open these up on your trading platform, perhaps you're not going to see them this way because your graph or your charting software probably adjusts the y-axis so that the price is shown in a different scale. So you have to account for that. In this case, I've done that, and I'm plotting these prices on the same scale. That's why they're accurate when we compare them one to one. So right away, if we were thinking about something being volatile and something else being stable, we could say that Boeing is a volatile stock and Johnson & Johnson is a stable stock. Now, let's do an analysis on these two underlyings and how their options might behave and what their options actually show in real life with real market data. So now we're looking at the same price chart with both Boeing and Johnson & Johnson. Remember, I've already standardized and I've accounted for the differences in the price axis, and the time is the same. We're analyzing here basically every candlestick is representing 1 day, and this is the time, which is roughly or actually exactly 1 year. So this is 1 year worth of data, and every candlestick is 1 day. It's representing the price changing 1 day. So right away, from the moment we start analyzing this, we can see that Boeing, even before this big drop, used to be more volatile than Johnson & Johnson. And with this large price change, of course, we can now say that it's extremely volatile because we're talking about a price range of $400, and now it's trading at $150, and at one point it was near $80. So it's quite a swing in price. We're not going to analyze Boeing as a company. I'm just using a real company, and because we're going to look at market data. Both these underlyings are trading at the same price, so it's a good way for us to see how volatility impacts the pricing of their options. So both of them are trading at prices that are very close to each other. 150.55 is Johnson & Johnson, and Boeing is trading at 151. So now we see that they're priced at just about the same price. And what we're going to do now is we're going to take a look at some options, and we're going to take a look at their options prices so that we see, because now as we were discussing, the current price of the underlying is the same. We're going to look at the same expiration. We're going to basically look at the same strike prices, and the only factor that's going to be changing is the implied volatility. So the volatility of the stock, and we'll see how that makes the option prices different. We're going to be analyzing the 170 call for both and the 135 put for both. So we're going to look at out of the money options, the call, the put, and we'll see how they're priced. So we have the pricing for, this is taken from my trading platform, from Thinkorswim in this case. It's real data, real market data, and I'm taking a look here at the 19th of June 2020 expiration. So just around a little bit over 60 days to go for both Johnson & Johnson here and for Boeing. Okay, so remember, on the left hand side we have the calls, and on the right hand side we have the puts. And now we do an analysis. So let's take a look at the 170 call for Johnson & Johnson. It's trading between 83 and 90 cents. So this is the bid, and this is the ask. So we're going to say that fair value is probably a price that's in between these two prices, between the bid and the ask, something that traders would refer to as the mid price. So for Johnson & Johnson, the 170 call is trading at around, let's say, 86 cents. And for Boeing, it's $15, $15.15 and $15.40. So it's quite a difference. We're looking at the same strike price, the 170. They're pretty much at the same price. This is the same expiration. The only thing that changes is how volatile Boeing is when you compare it to Johnson & Johnson. So we have here the price, the mid price would be around $15.30 for Boeing and 86 cents for Johnson & Johnson. So with both trading at around $151, the right to buy stock at 170 is trading at $15 for Boeing and 86 cents for Johnson & Johnson. Quite a difference. Just around 15 times bigger. Now let's take a look at the put. Do the same analysis. The 135 put for Johnson & Johnson is trading between 276 and 295. And the one for Boeing is trading at 1650 to 1675. So quite a difference as well, from just around $3 to just around $16. So you can see that this is the same put, 135 put, 135 put. The price is just about the same, 151-ish. And the expiration is the same. The only thing that's changing is the volatility level. Okay. Also, notice here that we're talking about 1660 versus 280. So the difference is big, but not as big as on the call side. This is because of skew. It's another lesson we're going to be doing in the near term future. But basically, the way the options are priced, when you look at the prices on the upside, is a little bit different than the prices on the downside. So what can we take away from this? Well, the thing that we can take away from this is to notice that just because Boeing is much more volatile than Johnson & Johnson, their options are going to be priced more expensively, both calls and puts. Okay? Because we're analyzing the same expiration, same strike prices. The only thing that changes is the fact that this is Boeing, this is Johnson & Johnson. We know that volatility is a factor. So that's what's driving the price much higher. That's why implied volatility or volatility is so important. Now, how do we measure volatility? What is it? We just said that Boeing is more volatile than Johnson & Johnson. Well, we're going to talk about this in another lesson. But I can tell you guys that, for example, in this case, the implied volatility of Johnson & Johnson is 35%, and the implied volatility of Boeing is 115%. So later on, we're going to see how to measure this. But just as of now, the important thing to understand is the concept that things that are volatile or more volatile are going to be more expensive in terms of option prices than underlyings that have less volatility and that are more stable. That's the most important thing in this lesson. Later on, we're going to see both how to measure volatility, and also we're talking here about an implied volatility. Who is implying it? Where is it implied? Well, we're going to take a look at that in another lesson. But for now, we can just understand that volatility affects option prices, and it affects the options in a very, very big way. So I hope this was useful for you guys, and I hope to see you around next time. And I hope this concept of volatility was clear. Thank you and goodbye.